Hi, everyone. Welcome. We're glad that you were able to join us this evening for What is CalABLE and How Can It Help with Financial Planning? It is the fourth in a 5-series financial planning series of Connections California spring semester. Connections California is Parents Helping Parents statewide online resource and information hub for transition to adulthood and adult services. I'm Alyssa DeFilippo. I manage that program, and it's my pleasure to introduce the presenters for this evening, who have been the presenters for the past 3 events and the one more we have left. They're from the Special Needs Planning Group in Santa Clara. Ken Prodger is a financial advisor who specializes in helping families plan for the future, including special needs trusts, life care planning, letters of intent, and how to obtain and preserve government benefits. Ken understands that parents of children with special needs often feel overwhelmed with therapies and IEPs and countless other issues, leaving little time and energy to address financial concerns. And yes, he knows firsthand because Ken has a son with special needs, and he is also a past board chair of Parents Helping Parents. So we thank you for your service, Ken. It's the 4th time, and I'll keep saying it. Scott Gill is a seasoned financial advisor with a passion for building long-lasting relationships with his clients. He specializes in providing financial planning services to families with special needs, helping them to achieve their financial goals. And as a member of Financial Services Institute, he brings a wealth of knowledge and experience to his clients. I want to thank Beatrice Boyker for being here and translating this evening. And without further ado, we'll take it away.
Wonderful. Thank you so much for the great introduction, as always, Alyssa. So let me just prep here and transition into our presentation. Okay, so let's see. Force the screen.
Looks good.
Alrighty, looks good. Ken, you can see it too?
Yep.
All good. Okay, perfect. Well, I'll get us kicked off. So tonight's presentation, Achieving a Better Life Experience Using ABLE Accounts. So as Alyssa kindly introduced us, this is number 4 out of a series of 5. And today we're going to be diving deeper into ABLE accounts, specifically CalABLE. We hope to cover a wide range of information, not only exploring some of the history of the program, but also some key facts, figures about the account and how you can leverage it. Before we step in, though, we always like to reference just the image that we have in the background, right? We see the image of the labyrinth, right? The 2-tilt axis, where we have the marble. We're trying to navigate the marble through these series of mazes. And ultimately, along the way, what we're trying to do is we're trying to avoid these pitfalls, right? Pitfalls can come up, some expected, some can be unexpected. And what we find when working with families that have loved ones with special needs is some of the challenges that they face and some of the opportunities that they have are typically not the same as a family that doesn't have a loved one with special needs. And an ABLE account is one of the tools that families do have accessible to them as they go through and they plan not only for today, but also for the financial well-being of their loved one, what could be several decades down the road. So as always, we have our important disclosures. And Ken and I, we are independent financial advisors, but what we are not attorneys. So we do not practice law, right? We do not draft legal documents such as special needs trusts. We do not draft wills. We do not draft revocable living trusts, okay? We're also not tax advisors in the sense where we are not filing your tax return for you, right? As financial professionals, we do coordinate and work with professionals in these fields, right? Whether we're helping to introduce our clients to trusted estate planning attorneys that also specialize with the special needs community, or we're working with other professionals that our clients may already have a relationship with. We are here to complement them, but we do not partake in, we do not take on the responsibilities of those people in terms of the draftings or the filing of tax returns or the estate planning documents themselves. So a little bit about us. I know we've covered this on every presentation as well, but I think one of the things that Ken and I want to emphasize more than anything else is working with families that have loved ones with special needs is not just a bullet point that we put on our website, right? This is what we do. Ken has shared this several times in the past, but 80% of the families that we serve and we support do have loved ones with special needs, right? And so when we say that we work with this community, we're heavily ingrained in that. And many of the designations that you see on this page here support that, right? So the CFP, the Certified Financial Planning designation, right? That is a certification that proves that we have gone through several years of education, understanding and learning how to coordinate things such as your risk management versus your insurance, your investments, your estate planning. The Chartered Special Needs Consultant designation takes that a step further, and it shows that there are unique needs, right, as it pertains to the wealth of families with special needs loved ones, and that may not be the same as other families that are out there. And so what we've done is we've taken the time, energy, and effort to not only gain the information that's needed, but also to get the specific credentials that allow us to support this community to the best of our ability, right? Ken has been a part of PHP for a number of years in the past. That's helped provide us with this wonderful opportunity to continue participating and supporting not just with Connections California, but with the local PHP office that's here in San Jose. We're also a part of the Academy of Special Needs Planners, which gives us the ability to coordinate with other practitioners that are not just in the state of California, but that are all across the country. It's not uncommon for some of our clients to ultimately move out of the state of California, or we get introduced to another family member that may not be living in California to begin with, right? If we can help be a resource for folks that are here and that are outside of the borders of California, we can certainly do so to ensure that families are getting the best help and support that they want and that they may need. So as we start taking a look in summarizing where we've been, right? We love showing this chart because oftentimes financial planning is not as clean and simple as having all the pieces of a puzzle fit together. So although today we're talking about the ABLE account, let's revisit a little bit of where we've started from, right? We originally were looking at, well, what do we do and what's a letter of intent? Okay, what's a special needs trust, right? How does a life care fit in? Okay, many folks are regional center clients here, right? Next week, we're going to be talking about the concept of a conservatorship and specifically a limited conservatorship, right? In as much as our needs-based benefits factoring into our family's wealth picture, such as SSI, or maybe the entitlement program, SSDI. At the end of the day, though, this is really about being an advocate for the special needs loved one and maintaining their quality of life. So again, today's presentation, as we dive into the ABLE account, is about understanding what this tool is, how this tool fits in with some of the other pieces of the puzzle, and helping to get people more familiar with whether or not it could be a good fit based upon your own individual circumstances. So here are the steps that we typically go through when we're working with a family, and that, again, we've talked about before in the past. First and foremost, we're always looking to identify the main issues, concerns, and goals that a family has, right? At the end of the day, each individual, each family is going to be unique in their own circumstances and in their own resources, okay? Once we can help identify where we're trying to go, it becomes easier to then start mapping out a plan, okay? And that's where we start looking into the idea of what a life care plan might be. What is the vision, right? And when we talk about a vision, it's helping to define your dreams, right? Your goals, the wishes that you have, right? Not just for today, but for moving forward, right? To ensure that the future care of your loved one will be handled just as how you want it to be while you're still with your loved one, right? So we're going to talk, as we mentioned, more about conservators and what a limited conservatorship is next week. But as we take a step forward and we start identifying financial resources, right? What are the existing tools that you have in your toolbox already, right? Could they be the acceptance of certain types of needs-based government resources, right? Might they be entitlement programs, right? Either based upon a parent or based upon the work history of the special needs loved one to begin with, right? Are we dealing with properties? Could there be insurance policies, right? Might there be extended family members that are looking to provide financial support at some point in time as well? Okay, we want to understand all those moving pieces to help organize them in the best way possible. Okay, then we can start taking a look at the costs, right? What is it going to cost to maintain a certain quality of life, right? Is it feasible to maintain that? What are the levers that we have to play with, right, to help give someone the best opportunity, right, to maintain this standard of living, okay, while keeping in mind all of the sometimes biases, all of the preferences, right, and all of those wishes, hopes, and dreams that we talked about up here in this life care vision plan. Okay, so skipping ahead a little bit more, right, we're going to start eventually looking at wills and legal documents, right? This is where partnership with an estate planning attorney can come into play. Again, some of our clients already have them. Some of them will want the assistance in having a recommendation sent to them based upon the knowledge that we've gained about said family, okay? Ultimately, that could lead to the establishment of a special needs trust. And if you remember from a few weeks ago, what was really the spirit of the special needs trust? Well, you can really boil it down to two pieces, right? The first piece of the puzzle is preserving government benefits, preserving needs-based government benefits, and control. Okay, so how does the ABLE account fit in with that? Okay, and again, we'll dive into that in a little bit in terms of how the flexibility can come into play, the accessibility of these resources, contributions that might go into the account. Okay, and then ultimately, as we start going to the latter pieces of this comprehensive planning process, we want to get other family members involved, right? It's not uncommon for us to see that siblings or the next generation could be a part of an estate plan. They could be taking on roles of trustee or successor trustee, okay? We may want to get parents or grandparents involved that may have already set up an estate plan and may want to leave a legacy, some of which could be split among grandkids, some that are neurotypical, some that have special needs, okay? And then lastly, we want to have a process in place upon which we can review the plan. Remember, at the end of the day, these plans, they're meant to be fluid. They're not intended to be set in stone where once you have it in place, it's not going to be pliable and something that you can adapt as your needs change and truthfully as legislation changes. So having a regular process upon which you can evaluate what's new and evolving in our life versus changes that are taking place perhaps on the legislative side is very important. Okay? And so I think from there, what we're going to do is we're going to start talking about the history, a little bit of the background and the history of the ABLE account. And I'll just share a few pieces, Ken, before I transition over to you. But, you know, the ABLE account, let's first and foremost talk about what it is: achieving a better life experience. Okay. Now, if we take a few steps back, right, prior to 2014, when this bill was passed, okay, it was actually called something else, right? It was a little bit wordier, but it was called the Financial Savings Account for Individuals with Disabilities, right? FSAID, right? It's a little bit of a mouthful, but long story short, in 2010, it was retitled, renamed to ABLE account because the better life experience was more of, it was a phrase that better encompassed what the intention and the spirit of this bill was meant to be. And the fact is, it was not uncommon, and it was known that families that have loved ones with disabilities and special needs have certain financial constraints on them, okay? And when these constraints were put in place, whether it's by trying to qualify for certain needs-based benefits for SSI, for Medi-Cal in California, or for Medicaid for those that are outside of California, it tended to limit the ability for someone to be able to save above and beyond what these meager asset thresholds would be. Now, we know today that especially when qualifying for Medi-Cal, some of those asset-based tests are not the same as what they were years ago, but for SSI, it's a little bit different. And so what the ABLE account did is it started to gain more momentum is it provided an opportunity for families to be able to store additional assets in a sheltered place that would not count against them as they were still trying to initially qualify for or to maintain qualification for some of these benefits. Okay, now it took several years before this to come into place, but in 2014, it actually passed. And it was part of the bill, this House Extenders bill, as we have what's over here. It was part of a bill where 49 other tax bills were actually set to expire. The ABLE account was included as one of them, and it was garnering a tremendous amount of support from many organizations that a lot of families were already participating with. Many of the families that we work with here in the Bay Area are associated with too, whether they be the Special Olympics, whether they be Autism Speaks, whether it even be Easter Seals. They saw that there was a need. There was a need for many of these families to be able to continue to save additional wealth above and beyond what they were able to do at a certain point in time, up to that $2,000 limit. But there wasn't a resource to be able to allow them to do that. And in some cases, setting up and or funding a third-party special needs trust may not have been the most economical path for people to take. The ABLE account, when it got set up, was a great opportunity to act as a segue, to act as a complementary piece, either before a special needs trust could be funded or in addition to a special needs trust, because there were provisions that allowed easier accessibility to the money. Now, fast forward a few more years, California was a late adopter to open up the plan itself. Okay, so when the ABLE Act was actually passed, California was not originally slated to open the doors to allow folks to set it up. Okay, so California residents had to look elsewhere, right? They had to look to other states that allowed them, right? I know, Ken, you can share a little bit more about this in practice, but Tennessee was one of the states that opened their doors up, and there was an influx of folks that were going to set the Tennessee plan up. Now, when California made their doors available, and when this provision was finally available, what are some of the big perks that we had here in California? Well, as we highlighted on the screen, first and foremost, there was no Medi-Cal payback, as in, for the family members that are on Medi-Cal and that are having some of their health-related expenses paid through the Medi-Cal program, they didn't have to worry about Medi-Cal coming back and clawing back any type of leftover money in the ABLE account if and when the ABLE account owner passed away. Some states do have that provision where there is a Medicaid clawback. California was very specific where they said, no, we do not allow that. There are some other states that prevent Medi-Cal or that prevent Medicaid from clawing back. California is included in that group. Okay. Second, okay, California opened the doors up to allow residents from other states to participate in our state plan too. Some states don't allow that. Some states will only allow their state residents to participate in their plan. California saw it as an opportunity where this is a federal program. As a federal program, we don't want to push people away if they choose to participate in the California plan instead of where they permanently reside. Okay. And then the third piece of the puzzle that we have listed over here, which is also important, is CalABLE accounts are exempt from money judgments. So money judgment being, well, what happens if there's a lawsuit? What happens if there's a lawsuit and money is owed to some third party? Well, the funds that are inside the CalABLE account are actually going to be protected from that. Okay, so although it took a little bit more time before California to become available to it, California has structured something that tends to be very favorable, not just for California residents, but also for individuals that are outside of the doors here, or outside of the doors of California itself. But I guess with that being said, Ken, I'll pass it on to you. And if there's anything else you'd like to include on the ABLE history, welcome your feedback. And I think you're on mute.
Okay, thanks, Scott. Yeah, so the big thing with the ABLE account is parents really rallying and approaching different legislators saying, hey, for my neurotypical child, I could put money away for college and save for them, and I get a tax advantage for that. How come I can't do anything for my disabled child? And so that was the main crux of to do that. And so they actually modeled it after college savings accounts. It's in the tax code, whatever, it's 529A, which is the ABLE account. A regular college savings account is called the 529 plan. So yes, it took a while for California to get going for many different reasons. But certainly California, was the first state to buck the federal requirement that there was a Medicaid payback. So California was the first state to enact law saying there is no payback. And of course, certainly being from California, California does not always follow what the federal government wants to do, and vice versa, or whatever. So that's took a while to get that through. The one thing about not having a clawback and not being recoverable, it is for California residents only that live in California. Okay, so the questions that haven't been really answered yet is, what if you live in California, you establish a CalABLE account, and then you move out of state, and then the beneficiary passes away, is that ABLE account recoverable from a different state? I think technically it may be. We haven't really crossed that bridge yet. It's new enough that we haven't crossed that, but the specific California legislation is CalABLE for California residents. So the big thing is, who's eligible to open up an ABLE account? So first of all, it's somebody who has developed their disability prior to age 26. Now there's a caveat that beginning in 2026, the eligibility age goes up to 46. So that's really important. So you have to have some sort of documentation or whatever that the disability occurred prior to age 26 with developmental disabilities. Obviously, that's very easy to establish. But sometimes it could be, somebody from a car accident or something like that is disabled from something other than a developmental disability. That age of onset is really important. So, nope, Scott back. Okay. So what do they have to do? They have to meet one of the following criteria. So the first one is they either have to be considered disabled by the definition of SSI, Supplemental Security Income, or SSDI, which is Social Security Disability Insurance. Now, Scott and I did a presentation on that last week, so we're really not going to go into that. But if you qualify for one of the programs, you automatically are eligible for an ABLE account. The self-certification part of the ABLE account is where when you go on the website to do it, you're just going to check a box that you qualify. Technically, you would, if ever addressed, you would have to provide some sort of medical record or history that certifies what that disability and diagnosis are. So it's self-certification. So far, we've never had anybody that has ever been questioned. I kind of think of it back to the old health savings accounts, for those of you that are old enough, where when you were with your employer, if you had an expense or whatever, you got to submit a receipt for it to be reimbursed. And then finally, now you just get like a debit card and you can use it however you want. So really, self-certification is really self-policing. And we do not see any issues with where the Social Security or whatever is questioning the ability of of what the definition of a disability is. So self-certification is really important for parents to understand. Obviously there has to be some sort of disability, but don't get caught up so much of what that level of disability is going to be. Okay, so as I mentioned, it is modeled after regular college savings accounts. So a couple different things just of California versus some other plans. So in California, contributions are not tax deductible for the donor in California. Now that some states do allow a state income tax deduction on their plan, again, for residents. So there's, I'm drawing a blank on some of the states that have that, but let's say it's Oregon. If you contribute to that plan, you actually get to write off on your state taxes as a deduction, not on your federal taxes, on your state taxes. That's also the same thing that we do for college savings accounts as well. Some states do allow a state tax deduction for that. California does not. The amount that you can contribute to an ABLE account is tied to the annual gift exclusion set by the IRS. So when it first was started many years ago, I believe it was 14,000. It's now 18,000. So you can contribute 18,000 into an ABLE account. Where that money comes from, it doesn't matter. It could be 18 people contributing 1,000, or it could be one person contributing 18,000. But the total contribution to the ABLE account cannot exceed 18,000, with one exception. And that one exception is if the beneficiary works, they can include up to $14,580 from their earnings. I believe that's 138% of the poverty level. I forget what the exact calculation is, but those things change every year. So just to give you an example, in 2023, the gift exclusion was $17,000. So it went up $1,000 for this year. So again, anybody can contribute. So as we mentioned, sometimes birthdays and things like that, people go, gee, what do I get little Johnny for birthday? Well, you could contribute to his ABLE account if you want. Now, the advantage of the ABLE account, what's the big advantage, is those funds grow tax-free. Okay, so it's much like a Roth IRA or a college savings account or a health savings account. Basically, if you put in 18,000 and that grows to 20, you can withdraw the 20,000 and not have to pay taxes on that 2,000. We'll go through a little bit of what qualified expenses are, but they're pretty generous. So you get the tax-free growth. So a couple different things when you're contributing to an ABLE account, put money in it and let it grow. Some people put money in the ABLE account and immediately take it out. It's like, well, you're not getting a tax deduction for it. You're not allowing it to grow. So you're not really getting some of the benefits of the ABLE account to be able to get that tax-free growth. As I mentioned, disabled prior to age 26. There is a maximum value that you can have in California, $529,000. But really forget about that number because that's not important. The important number is at $100,000, SSI will be suspended. Okay. Now, this 100,000, this was back 2014. Okay. One of the things that Social Security did is they did not index this for inflation. So that's a big shortcoming of the SSI that again, years down the road, that 100,000 is going to be worth less and less and less. So, but even if SSI is suspended, your Medi-Cal is not. So even if you go over that amount and you're not dependent upon the SSI, don't worry about it. Let's say your child is an adult and now is getting SSDI based on their own work history or the parents' work history. It doesn't really matter because you're not trying to qualify for SSI anyhow, and Medi-Cal would not be affected. So again, it's a tool, know what the rules are. And sometimes, the rules, it's not that big of a deal if you lose, the SSI, if you've switched over to SSDI. Couple different things. So the shortcomings of the ABLE account is that there is a payback provision. It's similar to a first party special needs trust, except for California. So when we talked about special needs trust, first party special needs trust, third party special needs trusts, we went through all of that. If you are a resident, let's say of Nevada, and you're contributing to the Nevada ABLE account or whatever, that means if the beneficiary passes away, that those funds would be used to reimburse, pay back Medicaid in that state. So it's important to be aware of that, and use that as a planning tool, to make sure that when the beneficiary passes away, that there's little, if any, funds in that. Again, California is different than all the other states. Okay, so what is CalABLE? So CalABLE actually is run by a fairly new company. So people that have been with the CalABLE for a while realize that I believe this is the third. I think it was Fidelity at one time. It was TIA Cref at another time. Now it's Vestel State Savings LLC. I must admit, I've never heard of them before they took over the CalABLE. They're basically using Fidelity, Vanguard, and Schwab different mutual funds. How ABLE accounts and 529 accounts really are managed is California goes out to different organizations and say, okay, do you want to manage our college savings account? Do you want to handle our ABLE account or whatever? And then they bid for that. And so in many ABLE accounts and college savings accounts, the individual fund fees may be a little bit higher because California is going to charge them a little bit for some of the administration. So the fees and expenses now really run about $30 a year as an account maintenance fee. The different expenses for the different mutual funds are roughly 0.25% to 0.5% in terms of underlying fund expenses with those different funds. So even though when you say, gee, the Vanguard fund, you know, it's still 0.28, which is probably higher than what the retail version of that mutual fund would be. There's other fees that you have, whether it's the annual print and make paper delivery fee. They are currently waiving the prepaid card fee. So one of the nice things with an ABLE account is you can have a prepaid debit card. So this is how you are able to use TrueLink, which is a company that's I believe down in LA or San Francisco, that you can, your beneficiary can have a debit card and then can go and use that for food or things like that, that you don't have to micromanage that. The great thing about the TrueLink card is that you can control some of the expenses of saying where and what can that person purchase. Okay, so the big thing, what are qualified expenses? Almost anything. The Treasury Department back about 9 years ago basically said it should be broadly construed of any benefit related to the beneficiary in maintaining, improving his or her health, independence, or quality of life. That's a very, very broad definition. So especially in the beginning, people would say, well, gee, does this qualify for an expense? You know, can they go to McDonald's and buy lunch? Yes, they can. In fact, that's an interesting thing with TrueLink. McDonald's is one of their biggest vendors of these debit cards. So certainly the definition is up above: education, housing, things like that, health, any type of medical expenses, any type of expenses are pretty well covered. Sometimes we ask people, well, they say, well, gee, my son, when he was born, we set up a college savings account. Can an ABLE account go for college? We're not, maybe our child will be able to attend college. Yes, an ABLE account can use a funds for higher education, whether it's special education in high school or college. So really don't worry about what you can spend the money on. As long as it's basically for their benefit, then you can go ahead and use those funds for that. The funds, it also doesn't have to be disability related. So again, if they want to go to McDonald's to get a lunch, they can do that, even though it's not, quote, related to their disability. Okay, so the TrueLink debit card, this is a little thing from them. What's nice about this is they do allow you to control whether what type of institutions can be allowed and what cannot. So, if you use the the block on here on the example, like they have it blocked to pay for utilities. Why would you block that? Because then that would could run into in-kind support and stuff. So you don't want that to be possibly dinged for that. And you may say, gee, we will allow different things for them to purchase, or they may not. Maybe you have some dietary restrictions, so you want to turn off that they can't use it for fast food, but they can use it for other things. So it gives you a lot of flexibility. It's getting better and better every year of what TrueLink does. But in meeting with them about a year or so ago, yeah, McDonald's was one of their top vendors in terms of where the debit card was being used, and so was Walmart. So, you know, it's people going in and where they can buy some clothing or get something to eat. You know, it's used for those miscellaneous expenses. That's really nice. You know, especially from a trustee standpoint, that you don't have to micromanage that. We just met with a trust company today, and they help facilitate that so that there's always funds going to the debit card so that the individual has the financial independence to be able to make some decisions and to be able to buy some things. Just think in your own life, if you had to get approval to go out to McDonald's to get lunch, right? It's certainly great for their well-being and independence to be able to have a debit card where they can say, okay, I'm gonna buy lunch for myself. So it's really beneficial for the individual with the disability. Scott, so I'm we've got a little bit of time, so let me explain some of the different things of how, in a practical sense, how do we use ABLE accounts? A couple different things that we do. Sometimes when we talked last week, we talked about, okay, gee, you qualify for SSI, you know, maybe you get 3, 4, 5, 6 months worth of back pay, quote unquote, from SSI. What are you going to do with that? You know, you have 9 months to be able to spend that down. Well, a great way to do that is put that into an ABLE account. Okay, it's a one-time expense to be able to do that. Put that in there, and then you've just taken out that whole necessary thing of, okay, how do we figure out how to spend this down and things. You know, in years past, you know, we would have to go through, okay, gee, you got a check for $6,000. How are we going to spend that down so they don't exceed the $2,000 asset limit, you know, 9 months down the road? Unfortunately, some people thought that they had to do it within that month, and so they just went out and bought a bunch of things. But you do have 9 months, but an ABLE account is a great tool to do that. We also have things where people maybe have a special needs trust that they've already funded, or a UTMA account. Any type of things where there's assets in a child's name or for their benefit. We talked about the taxation of special needs trusts and how that can be onerous for the individual. Well, transfer those funds over into an ABLE account. So, you know, we have several clients now that every year, that in the beginning of January, we transfer over that gift amount from their special needs trust over into an ABLE account. And it could be a third-party special needs trust. It could be a first-party special needs trust. You know, it's going for the benefit of the person. The advantage is you take something that's in a taxable situation and you're moving over into a tax-free situation. So it's a great way to do that. We also have some clients that years ago, that when California did not have an ABLE account, that they said, gee, okay, they opened up the Tennessee account. How do we deal with that? Technically, you can only have one ABLE account, but if you establish an ABLE account in the state of residence and you're now transferring funds from another state's ABLE account, you can do that. The only problem with that is you are still limited to the 18,000. So let's say you've done it for, you're kind of stuck because now you can 1,000 from state A back to California. That's great, but that now is your entire contribution, so you can't add any more money to it. So that's kind of a loophole. Thing with the regular college savings accounts, which this was modeled after, you had a 5-year cumulative addition that you could make. You could do the gifting of 18,000 times 5 in a lump sum. The IRS allowed you to do that. Right now, ABLE accounts are not allowed to do that. So that's another shortcoming that we're trying to do with ABLE. So it's a great tool. It does not replace a special needs trust. It augments a special needs trust. It's one of the things that you say, there's very few things in financial planning where you say, gee, this is kind of a universal recommendation. An ABLE account is pretty much a universal recommendation. If you have extra funds that you can put towards the benefit of your child, put it in an ABLE account and then let it grow. Let it grow for that tax-deferred, tax-free growth.
Thank you so much, Scott and Ken. I know I see Scott is furiously trying to type answers to some questions before I cut him off. I thank you both. Thank you so much. We really appreciate your time and your effort. Beatrice, thank you so much. I know we talked a little quickly tonight, and I'm sure you were talking as fast as we were. Thank you everyone for coming.